Hi all, my name's Chris Lynch of Lynch Financial Group and welcome to this week's Keatley Weekly. Today we thought we'd focus on the end of financial year and some of the tips that we could maybe able to help you with. But firstly, I would like to make you aware that the information given today is general in nature and is not specific to your particular needs. In order to understand whether these would be specific to your needs, you would and should talk to a financial planner. So please seek out some competent financial advice. So with the end of the financial year fast approaching, it really is time to get cracking. Firstly, for self-employed people, you may still be able to obtain a tax deduction. As I said, you are running out of time though, so please be aware that some contributions for self-employed people can be claimed as a tax deduction. Additionally, people who run their own companies, so are employees of their own company, can also obtain a tax deduction for their contributions through the company. So it is very important. There are some limits that you do need to be aware of. For example, anybody who is 49 years of age as at the 30th of June last year, so 2014, they can contribute up to $35,000 as a concessional contribution, and anybody who is under 49 can have a contribution up to $30,000. So they're great incentives. The government obviously is wanting to encourage people to put in money in for their retirement, so it's a great initiative. So just one thing to remember, if you are making a contribution, it is very important, in fact it's vital, that you advise the super fund whether the contribution is actually a personal contribution or an employer contribution. They tend to be very hard. The tax department makes it very difficult to change this determination after it's already been done. So it is very important. There are also lots of incentives that are available for lower income earners. There is still a co-contribution available, and there's a thing called a spouse contribution which enables people to obtain a tax rebate of $540. And for employees, look, there certainly it's a good time to review the money that you have going into your superannuation. Whilst it's too late to do anything this year, certainly for next year, you should start to consider some options for contributions, being salary sacrifice. The government has introduced the recent intergenerational report, and this highlights some of the issues facing us going forward, and particularly for people getting through and during their retirement. And it is a serious issue. Just going forward, we know that from the intergenerational report that one of the greatest risks for people's superannuation and their retirement savings in general will be longevity. Put simply, people are living a lot longer now than they used to. For example, in 1975, there was only 122 people in Australia that were over the age of 100. By 2055, we've estimated that this will be higher than 40,000 people. That's huge in such a short period of time. And if you were born around 1960, most of us think that we probably only make 80, 85. The estimates, based on this intergenerational report, believe that the average person born in 1960 will actually live till 95 years of age. And it's pretty scary when most of us have only really considered how much savings we might need until 80 or 85. Also out of the intergenerational report, some of the things that came out of that was that the cost of healthcare in general is expected to double over the next 20 to 30 years. So no matter what your preference is, whether it be superannuation savings, whether it be placing the money in the bank or buying an investment property, obviously what we're talking about is ultimately the savings overall. So John Kennedy, great football coach of Hawthorn, once said, "Don't think, just do." And it really is pertinent when we're talking about your savings towards retirement. Just one thing too, if you are an employee, you're receiving the 9.5, which is the superannuation guarantee, the compulsory superannuation. Don't be fooled into thinking that this is going to provide you with sufficient funds for your retirement. Ultimately, the 9.5 was originally established purely to replace the government pension. So to take the onus of off the government providing you with a retirement pension. So If you really want to be able to retire comfortably, you can't just rely on the 9.5. So that's all. Thanks for listening to this week's Keatley Weekly. In the future, we'll have Anne come in and have a chat to you on some mortgage ideas. Later on in the year, we can also give you some other ideas around the financial planning. So thank you for listening.